Hello and welcome. This is a Uniwide presentation on free zones in the UAE and how to use them to optimize your tax burden. We'll cover how the zones work and how to choose one, how free zone companies are taxed, and what it takes to open a bank account. First, a quick map of the territory. The UAE is a federation of 7 Emirates. Most people know Abu Dhabi, the capital, and Dubai, the commercial hub. But there are 5 more: Sharjah, Ajman, Fujairah, Ras Al Khaimah, and Al Quwain. This matters because free zones aren't spread evenly across them, and where a zone sits affects both its character and its cost. And the spread is striking. Dubai alone is home to around 30 free zones, far more than anywhere else. Sharjah and Abu Dhabi follow with single figures, then Ras Al Khaimah, while the smaller Emirates have just 1 or 2 each. So when people talk about choosing a free zone, the widest choice and the sharpest competition on price and services is concentrated in Dubai. We'll cover 5 things in turn: the legal regime that sits behind free zones, the different types of zone and how they specialize, the company forms and licenses you can choose from, how free zone companies are taxed, and finally, what it takes to open and keep a bank account, which is often the hardest part. Let's start with the legal foundation. What a free zone is within the UAE system. Broadly, there are 3 kinds of company in the UAE: mainland companies, free zone companies, and offshore companies. A free zone is a specially designated area within the country where more favorable conditions apply to setting up and running a business. Think of it as a self-contained regime, with its own registrar and its own rules, operating inside the UAE. The clearest way to understand a free zone is to compare it with a mainland company. A free zone company is built for activity within its zone and outside the UAE, with some exceptions. Registration is fast and largely online, office solutions are flexible, and if you ever need to close the company, a simple striking off procedure is available. A mainland company is different. It can trade directly in the local UAE market, but it usually expects the founder's personal presence. A physical office is mandatory, and closing it down means a formal liquidation rather than a quick strike-off. It's also worth separating free zone companies from UAE offshore companies, because people often confuse the two. A free zone company can operate within its zone and abroad, uses flexible office arrangements, and benefits from special profit taxation, but it does prepare financial statements and an audit. An offshore company, by contrast, works exclusively outside the UAE, needs no office at all, and is taxed on the same basis as a free zone company. And here's a point people miss. That offshore company still has to prepare financial statements and an audit if it wants to keep the 0% corporate tax rate. With the legal picture clear, let's look at the zones themselves and what really sets them apart. The first thing that distinguishes zones is specialisation. Some are general purpose, meaning you can register almost any kind of activity there. FZCO and Mainland in Dubai and Rakez in Ras Al Khaimah fall into this group. Others are specialised. The financial centres, DIFC in Dubai and ADGM in Abu Dhabi, are built around regulated finance. And zones like JAFZA and DMCC in Dubai are geared towards trade and logistics. Matching the zone to what you actually do is the first real decision. Reputation is the second factor, and it's easy to underrate. A zone's standing affects how clients, partners, and banks see you. DMCC, for instance, is one of the oldest and most recognized free zones in Dubai. DWTC is among the leading zones for hosting major international events. For some businesses, that kind of name carries real weight. Cost is the third factor, and it varies widely. At the more economical end, SPC in Sharjah is a strong option, with a particular focus on the publishing sector. Ajman's own free zone is another affordable, multi-purpose choice. The cheapest zone isn't automatically the right one, but if budget is tight, these are good names to have on your shortlist. Once you've narrowed down a zone, the next questions are practical. What form will the company take, and what license does it need? There are 2 main company forms: Traditionally, a free zone establishment, or FZE, is the form with a single shareholder, suited to sole entrepreneurs, freelancers, consultants, and small businesses. A free zone company, or FZCO, was the form for 2 or more shareholders up to 50 and fits partnerships, startups raising investment, international groups, and joint ventures. In practice, though, that distinction has largely faded. Most free zones now register a free zone company in either case, whether you have one shareholder or several, and that is why it is the form you will usually end up with. Beyond those two, the range of structures depends on the zone you pick. Depending on the zone, you may be able to register branches of local or foreign companies, private or public joint stock companies, and limited liability companies. Some zones go further. DIFC, ADGM, and DMCC allow special purpose vehicles. DIFC, ADGM, and RAC-ICC allow foundations, and partnerships are available too. The point is that not every zone offers every structure, so the structure you want can itself narrow the field. Every company also needs a license, and the license defines what you're allowed to do. The main types are commercial, or trading, which covers a wide range of products and commodities, industrial, for manufacturing, import and export, and service for consulting and similar work. The financial centers, DIFC and ADGM, add a further category for regulated financial activity such as banking, asset management and insurance. Licenses are more flexible than they first appear. A single license can often cover several activities, and most zones let you combine activities from different categories under one license. Some zones also offer dedicated licenses for areas like e-commerce, logistics, education, media, virtual asset operations, and event management. So in many cases, you don't need separate licenses for related lines of work. One well-chosen license can carry them all. It helps to know what that initial cost covers. Typically, it includes advisory support in choosing the zone, the company form and the license, the preparation and submission of documents, liaison with the registration authority, and the official free zone fees themselves. One thing to note, the standard package usually includes a single workstation, often a flexi desk, and one residence visa. Any extra workstations or visas are charged separately. Setting up is only the start. A company also has running costs each year. Annual maintenance generally covers the renewal process and the documents that go with it, the official free zone fees, including the workstation fee and the renewal of the residence visa, plus bookkeeping and the preparation of financial statements and an audit. That last item, the audit, will come up again, both as a condition for the 0% rate and at the bank. Which brings us to the part most people are really here for, how free zone companies are taxed. 3 taxes matter. First, corporate tax. The rate is 0% on income up to 375,000 dirhams and 9% on anything above that, applied only to the excess. Second, VAT, charged at a standard rate of 5%, with registration becoming mandatory once turnover passes 375,000 dirhams. And third, excise tax, which applies to selected goods and works the same way for mainland and free zone companies alike. There is, though, a far more valuable 0% rate available to free zone companies, and it works differently from the basic threshold we have just seen. A qualifying free zone company pays 0% on all of its qualifying income, with no upper limit at all. The catch is that this rate is not automatic. To claim it, the company must qualify as what is called a qualifying free zone person. In broad terms, that means keeping adequate substance in the UAE, earning qualifying income while holding any non-qualifying revenue within the permitted limit, not electing to be taxed under the standard rules, following transfer pricing rules, and producing audited financial statements, among other conditions. Miss any of these and the 0% falls away. The company is then taxed under the standard rules, at 9% on income above the basic threshold. So what counts as qualifying income? Broadly, 4 things. Transactions with other free zone residents, subject to exceptions. Transactions with anyone else where the activity is a qualifying activity, as set out in Ministerial Decision number 229 of 2025. the ownership and exploitation of qualifying intellectual property, and a small allowance for other income, capped at 5% of total revenue or 5 million dirhams, whichever is lower. Those qualifying activities are defined in detail, again in Ministerial Decision number 229 of 2025. They include manufacturing or processing goods, trading in qualifying commodities, holding shares and securities for investment, and the ownership, management, and operation of ships. They also cover reinsurance, fund management, and wealth and investment management services. The list goes further. It takes in headquarter services and treasury and financing services provided to related parties, the financing and leasing of aircraft, the distribution of goods from a designated zone, and logistics services. There's also a catch-all for activities ancillary to these. If your core business sits on this list, the 0% rate is within reach. If it doesn't, that's where the risks begin. Take working with mainland UAE companies. Here, only income from qualifying activities counts as qualifying. Income from other transactions with a mainland company is not qualifying, and it's taxed at 9%. There is some relief through what's known as the de minimis rule, which gives a little headroom, but the principle holds. Dealing with the mainland needs care, because not all of that income qualifies. A similar trap appears even when you deal with other free zone residents. The income is qualifying only if that resident is the final recipient of the goods or services you're paid for. If they're merely passing them on, the income stops qualifying and is taxed at 9%, again subject to the de minimis rule. So it isn't enough to know that your customer is in a free zone. What they do with what you supply matters just as much. Coming back to VAT, here is how the rates break down. The standard 5% applies to supplies made to customers in the UAE and the wider Gulf states. Exports of goods or services outside the UAE and the Gulf are 0 rated. Imported services are handled through a 5% reverse charge. Financial services are generally exempt. And some supplies sit outside the system altogether, such as overseas supplies by a designated free zone company, and services provided by UAE government and free zone authorities. Within free zones, VAT has one more wrinkle. Some zones hold the status of designated zones, and for them, VAT does not apply to supplies of goods within a single designated zone, imports of goods into a designated zone from abroad, or movements of goods from one designated zone to another. Outside those specific cases, though, the general 5% rate still applies, for example when you're dealing with a mainland company. That covers tax. The final piece is banking, opening an account and keeping it open. When you apply to open an account, the bank looks closely at the company itself. It will want the incorporation documents, the trade license, and the office lease agreement. And the scrutiny doesn't stop once the account is open. When you later update your account information, banks increasingly ask for tax payment information and audited financial statements, which is another reason that audit keeps coming up. Banks also examine the people behind the company, the beneficial owners. Expect to provide a passport, proof of residential address, and evidence of the source of funds. They'll also screen for risk, any links to sanctioned persons, statements from sanctioned banks, or connections with sanctioned countries and territories can block an application outright. And one practical requirement is easy to overlook. The person authorized to sign on the account must hold a UAE residence visa. Choosing the right free zone, the right structure and the right license, then keeping the tax position clean and the bank comfortable, is rarely a single decision. It's a chain of them, and they connect. At Uniwide, we work across company formation, tax and advisory, helping international businesses set up in the UAE and stay on the right side of these rules as they grow. If today's overview has been useful, that's the work we do every day. Thank you for watching.